Well, I think it's natural that you'd try and see some consolidation. The challenge here will be finding vendors with quality assets that are willing to sell for the prices that buyers want to see. And we saw that instantaneously with Oil Search and Woodside. Oil Search is a prized asset, there is absolutely no doubt about that. And so the board is going to be very unwilling to sell that for what they see as a very fair and full price. So Woodside will probably have to increase the bid if they want to cement that. We're investors in Oil Search, and we wouldn't be surprised to see Woodside increase that bid. Peter Coleman has shown by walking away from an investment in Leviathan previously that he will walk from bids if he doesn't see the prices right. But clearly he does want to move. The company's growth outlook is not a strong growth portfolio for Woodside, and so it is likely to see them make a move. And if it's not an Oil Search, they will probably be looking for different investments. Santos, you know, M&A is a function of where their balance sheet is. I mean, they've got $10 billion of debt. They're nearly at the end of investment, but their balance sheet is completely impaired. And so they're forced to look, which is the absolute worst situation that you'd like to be in. When oil prices are low, as you talked about, James, and you're forced to sell our assets, it's obviously not a good outcome. They do have a stake in PNG LNG, which, as we mentioned, is a prized asset. So that is one asset that we think that they could reach a full and fair price for. But the rest of their assets portfolio, probably arguably tier 2 and 3 assets, which are going to be difficult to sell in this market. So it's going to be interesting to watch how it plays out for Santos, but it certainly isn't a great situation for them. That's been the most fascinating story here of the last 12 months, is the US shale is clearly the disruptor to this market, and people had expectations that they wouldn't survive at $70 and then they wouldn't survive at $60. And just in the last year, the industry has managed to reduce that break-even cost by probably $10 a barrel. I mean, we have to remember this is a very, very new industry, and they're very flexible, and we've seen that. And people have underestimated the amount of costs out that would be coming from US shale. So production really hasn't declined at the levels that we might have expected 12 months ago. There's a lot of basins, there's a lot of sweet spots, and so it's very difficult to analyse. Even the best consultants in the world, you know, people like Fax Global, even the producers themselves, Exxon, Chevron, admit to not having a clear line of sight on what production response will be. I think in other basins, you know, Brazil, Asia, they can see from a bottom-up perspective which barrels will come out of the market at which prices. But US shale is very unpredictable. And so if we continue to see productivity improvements and lower rates in 12 months, you know, that supply might still be in the market, and obviously that's going to lead to lower prices. So it's been fascinating to watch, but the supply response probably hasn't been as people might have expected. Well, I think the opportunities are in quality assets. So if we think about Oil Search, we mentioned, you know, the stock came back to, I think, $5.50. And that's Aussie terms. So, and with the Aussie coming back from parity to 70 cents, you know, the value in US dollars term, which is how we look at these assets, really halved. And that's an opportunity because oil won't stay at $40. It's inevitable. It could stay here for a little while, but it's going to have to recover, we think, to at least $60. The forward curve is a great indication. It's the most liquid forward curve of commodities, so it gives a fair indication of what investors view the outlook for the commodities. And even over the last 3 to 6 months, the forward curve has dropped significantly. When Shell bid for BG back in January, I think it was, they were talking about $75 to $80 by 2018. Now, as we roll forward 6 months, that now looks like 60 to 65. And so there's been an expectation that the prices would recover, and that's really changed here over the last 6 months, which has pushed the valuations lower. So potentially presenting some opportunities for high quality, long life assets to be taken over.